Okay, joining us now to talk all about the U.S. economy is Ken Kuttner. He is the professor of economics at Williams College. Ken, good to see you again. Thank you.
Good evening, Tom.
Okay, so what's driving U.S. economic growth? Clearly, good news. The key takeaways that you have today from today's final read of the second quarter GDP.
Well, things are going pretty solid, probably even more solid, probably even more resilient than I would have expected. As was noted, consumption is really behind the continued expansion of the economy, which is not too surprising. 70% of the economy. Investment made a strong, contributed a strong chunk. The only notable piece of news in the release that would really changed my views at all was the upturn in the saving rate that had been taking a nosedive, which was raising concerns about consumers' ability to keep spending. That was revised up. Those concerns are now somewhat assuaged.
Okay, let's talk about unemployment, because the U.S. also released some new unemployment information, the lowest level of weekly unemployment claims since May. So what does that tell us about the current state of the U.S. labor market? Because clearly that has been a concern, where it's going, where it's been.
Yeah, that's interesting. The claims data, I wouldn't put too much weight on a single number, since the weekly claims data are really, really noisy. They bounce around from week to week. But really the bottom line is that the claims data have been flat, not a lot of upturn in either continuing or initial claims. And that's in contrast to the unemployment rate, which has been edging up. So a bit of mixed signals there and a little cause for encouragement.
Okay, so we have the positive GDP, GDI information. Kind of walk us through next week's all-important jobs report. What are the expectations for that? What are you looking for? And what could possibly be any kind of pratfall out there?
Well, the slower pace of employment growth we've seen the past few months, I think that's going to continue. Looking for a very modest increase, probably in the mid or even low 100,000s. Vacancy rate has come down a lot, so there's less sort of slack to be taken up. And also the labor force is growing more slowly too. And both of those fundamentals point to a slower trend employment growth rate. We're not going to be seeing 200 plus employment growth anyway for the foreseeable future.
And this is where we take the pulse of what the Fed has been doing. So do the GDP and unemployment claims figures support what the Fed has done so far? The decision to cut interest rates by 50 basis points in the second week of September. Did the U.S. Central Bank make the right move at the right time? And part, the most recent information shows, as what you're talking about, that consumer confidence appears to be healthy.
Yeah, well, this is a case when hindsight, of course, is always 20/20. But I think in this case, the Fed has been in this kind of a tricky situation, facing a tricky balancing act. Inflation is still a little bit above the target, and we have seen the softening of the job market. So there's some tension there. Some people have said that the Fed is moving too late. They should have cut rates at the previous FOMC meeting. On the other hand, there really wasn't, the inflation hadn't really cooled by enough to justify that kind of a move yet. So I think they've struck about the right balance. In hindsight, maybe they should move 25 in July instead of waiting down and doing 50. But I think they're pretty much spot on.
Ken, also there were concerns that by bumping up 50 basis points, that there could be concern that the perception was they acted too late and it could cool markets. But since they made that decision, we've seen new records almost daily.
Yeah, you're absolutely right. Sometimes when the Fed makes a stronger than expected move, people take that as a sign that the Fed knows something is wrong, that they don't, and react adversely. Fortunately, that wasn't the case here.
Okay, so how is this going to play out in the next 40 days here on the campaign trail, all-important campaign trail? Vice President Kamala Harris, former President Trump, they're going to use these reports to their best ends as the race for the U.S. president enters the final weeks. So what's your perspective on these latest respective economic agendas?
Well, the latest numbers are good news for Kamala Harris, I think. There's no immediate signs of softening. On the other hand, I'm surprised the Trump campaign hasn't made more of the edging up in the unemployment rate, since Trump has always been emphasizing his command of the economy, for better or for worse. One thing that did surprise me a little bit is the Fed's larger than expected rate cut. I would have expected the Trump campaign to have seized on that and said, hey, this is a politically motivated move. The Fed is obviously backing one particular candidate, but I haven't really seen that. So that was kind of a pleasant surprise.
I'm with you. I kind of waited for that shoe to fall, and it just didn't happen. So let's talk about the economic predictions for the third quarter, because that is going to come out, about a week before the presidential elections, and that is going to be a good harbinger for the rest of 2024.
Sure. Yeah, I think a safe bet is going to be, it will have decelerated from earlier in the year, that's for sure. After all, the economy's trend growth rate is thought to be around maybe 2.25%, 2.5%. We've seen a huge bounce back, obviously, in the couple of years following the pandemic, but we really can't expect that kind of growth going forward, given trends in the labor force, given trends in productivity. So we're definitely going to be below 3, probably closer to 2, maybe even, you could even shade that down a little bit lower depending on how you, the strength, because there's a lot of monetary contraction already in the pipeline. Some of that is going to continue filtering through and maybe even drive growth down a little bit below the 2% mark before rebounding.